Hence, we find ourselves here saddened by the notion that we won't be there, but knowing that this is something that we need to move forward with. So to the family, we express our gratitude for his service, and we would pray that you would have the opportunity to reflect, recall, and enjoy the memories of the wonderful things that he has done. We will hear next from the ranking member, after which I will ask us to engage in a moment of silence, and we will begin the hearing. We will now hear from the ranking member, Ms. Wagner.
I thank the gentleman, my good friend, Mr. Green, and the chair of this committee for yielding. I also want to offer my profound condolences on behalf of the minority party for Mr. McEachin. It's a terrible loss for the people of Virginia, his family, all those he represents. He served faithfully, and as he's laid to rest this morning, his thoughts and our thoughts and prayers are with he and his family, and we wish him Godspeed, and we will remember his service to this institution with great sacrifice and with a servant's heart. I appreciate the opportunity to say a few words, and also would like to participate in a moment of silence, as chair.
Thank you. And if you would, in your very own way, you may join us in a moment of silence. Thank you. Thank you, friends. The hearing will now come to order. This hearing is styled An Enduring Legacy, the Role of Financial Institutions in the Horrors of Slavery and the Need for Atonement. This is part 2. Slavery is our nation's original sin and one of the most horrific crimes ever committed against humanity. It was an era in infamy spawned by centuries of societal evil. It was characterized by kidnapping, rape, murder, enslavement of babies, denial of education, and forced labor. It is my honor to convene this historic consequential second hearing to continue the examination of the role financial institutions played in the perpetuation of this horrific crime against humanity and the need for atonement. In June of this year, Chairwoman Maxine Waters and I, together with subcommittee chairs Sherman, Cleaver, Perlmutter, Himes, Beatty, Foster, and Lynch, sent inquiries to the 10 largest U.S. banks and the 10 largest U.S. insurance companies, requesting information about their historical connections to slavery. While a number of institutions had researched their history and provided the committee with findings, many of them had not, and certain of those had no intentions of doing so. Many of our financial institutions have known connections to slavery and have profited enormously from centuries of economic prosperity that was built on the backs of enslaved people. In today's dollars, these institutions have a collective value in the trillions. Today, we will examine the actual valuation of slave labor and its impacts on the U.S. economy, how the exploitation of enslaved people caused the U.S. economy to prosper while severely disadvantaging the descendants of enslaved people throughout generations. Our institutions that profited and perpetually benefited from slavery and how they might atone for this history will also be examined. Ours is a great nation that will be a greater nation when we atone for our seminal sin the crime against humanity known as slavery. And in the course of today's hearing, I will examine one other aspect of it, and it is something that I call a perfect victim, a perfect victim. I will now yield to the ranking member for 5 minutes, Ms. Wagner, who is my friend, for her opening statement.
I thank you, Mr. Chairman. And again, I want to thank our witnesses for taking the time to testify before the committee today. While I understand this subcommittee has held hearings on this issue, I would also like to highlight issues affecting minority communities in the present, and that is inflation. Right now, the cost of goods is rising at a faster pace than the rate of wage growth, and people are being forced to put a larger portion of their paychecks towards necessities to make ends meet. Studies show that inflation is disproportionately more difficult to bear for lower income and minority households. Last week, during our full committee hearing on the ties between housing and inflation, we saw that many households throughout the country are limited by rent, by home buying, or by home buying power. I could pause for one moment, please. In many ways, the focus is on how our history has impacted the racial wealth gap and how Congress can help reduce burdens placed on lower income and minority communities. This cannot be achieved as a one-size-fits-all approach. As we have seen in the response to the majority's June 6th letter to the nation's top 10 banks and insurance companies, many respondents have implemented plans to address racial equity throughout the communities that they serve. This is a complex issue and one we must take very seriously so that all Americans can achieve economic prosperity. When we have seen instances of racial wealth gap, the promotion of strong and consistent economic growth has helped to reduce the gap by enhancing Americans' purchasing power and ensuring that government intervention doesn't increase the gap while attempting to find a solution. In the 8 months since that first hearing, one aspect of the economy that continues to disproportionately and negatively affect underserved and minority communities throughout this country is a continued high inflation rate. At the time of the first hearing, the Consumer Price Index, or CPI, reported that in February, inflation rose to a rate of 7.9%. In the months following, Americans were faced with a summer of rising costs and consistent inflation that peaked at 9.1% in June and remained well above 8% until October. Today, the Consumer Price Index still stands at a crippling 7.7%. More recently, the Farm Bureau estimated that America's families spent 20% more just a couple of weeks ago on Thanksgiving dinners than they did last year. Underserved, minority, rural, and low and moderate income communities across the country are facing the brunt of this inflation, using more and more of their paychecks on critical necessities and becoming less able to direct their income toward creating a secure financial future. In June, the New York Fed issued a report that confirmed that inflation disproportionately impacts Black and Hispanic Americans more than any other communities. Individuals who have lower incomes and historically have been able to build wealth do not have the same safety net as individuals with higher incomes or substantial savings. This makes combating the negative effects of inflation that much harder, because these factors, among others, inflation, will do nothing more than continue to increase the racial wealth gap. As Americans continue to head to the grocery stores, the gas pumps, and the stores during the upcoming Christmas season, they see their purchasing power is much less than it was. Congress needs to take immediate action to curtail this inflation and let these communities know we are focused on building a strong economy that they can thrive in. Fixing supply chains, supporting domestic energy production, and stopping reckless government spending can be a positive start to the deflationary effects that these families so desperately need. I thank the chairman, and I yield back the balance of my time.
The gentlelady yields. It is now my honor to recognize the chairwoman of the full committee, the gentlewoman from California, the Honorable Maxine Waters, for 1 minute.
Thank you, Chairman Green. At your previous hearing on this issue, we discussed the significant role slavery played in building up the U.S. economy and financial services industry and fueling our nation's wealth. Large banks and insurance companies have profited from the unjust economic legacy, yet the debt to the descendants of enslaved people remains unsettled. The results from the committee's inquiry into some of the highest and the biggest, the largest banks and insurance companies demonstrate that more work needs to be done to ensure that the damages resulting from slavery have been remediated and the racial wealth divide addressed. Quite simply, public apologies and acknowledgments are not enough. I look forward to exploring solutions that address this history of exploitation. And now I yield back. Thank you.
The gentlelady yields back. It's now my privilege to recognize the vice chair of the subcommittee, the gentlewoman from Georgia, Ms. Williams, for 1 minute.
Good morning, and thank you, Mr. Chairman. It is our responsibility to end this series of hearings with not just understanding, but as our chairwoman said, also a plan of action. Where do we start? I think passing my abolition amendment, which will end an exception in the 13th Amendment that still allows slavery as punishment for a crime. This issue will sound familiar to the bipartisan majority of members of the subcommittee that have co-sponsored my bill. It'll sound familiar to the 76% of Alabamians, 56% of Oregonians, and 80% of Tennesseans and 89% of Vermonters who voted in November to abolish this same exception in their state constitutions. Even with 191 bipartisan co-sponsors on my federal bill, we can't get it done alone. As the financial industry thinks about atonement, joining our push to eliminate this exception is a no-brainer. These are the types of issues that we need our industry's voice and support. Let's walk away today identifying as many of these solutions as we can. Thank you, Mr. Chairman, and I yield back.
Gentlelady yields back. Today, we welcome the testimony of our distinguished witnesses. First, we have William A. Doherty, Jr., who is Professor of Public Policy at Duke University. Next, we have Danya V. Francis, who is an Assistant Professor of Economics at the University of Massachusetts, Boston. Next, we have Lily Roberts, who is the Managing Director of Poverty to Prosperity at the Center for American Progress. Next, we will have Seth Rockman, who is an Associate Professor of History at Brown University. And finally, we have Sarah Felderman, who is an Assistant Professor of Conflict Resolution at the University of San Diego. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer that will indicate how much time you have left. I would ask that you kindly be mindful of the timer so that we can be respectful of both the witnesses and the committee members' time. Without objection, your written statement will be made a part of the record. Dr. Doherty Jr., you are now recognized for 5 minutes to give an oral presentation of your testimony. Dr. Doherty, you may be muted and you are not visible on our screen here. I saw Dr. Doherty earlier. Well, Dr. Doherty, while we are managing our technical difficulties, let us move forward. We have you now. Dr. Doherty, if you can hear me, raise a hand or say something. Thank you. Now you may proceed with your oral testimony. You have 5 minutes, sir.
Thank you. Thank you, Representative Green. I am William Doherty Jr., the Samuel Du Bois Cook Professor of Public Policy African and African American Studies, Economics, and Business at Duke University. I'm a specialist in stratification economics, a field that examines the sources and consequences of disparities between racial, ethnic, caste, and gender groups. I would like to examine the intimate connections between slavery, the financial sector, and the emergence of the Black-white wealth gap. Mirza Baradaran has written, "Slavery modernized credit markets, creating complex forms of new financial instruments and trade networks through which slaves could be mortgaged, exchanged, and used as leverage to purchase more slaves. In highly profitable, speculation-based markets, many white men built fortunes trading enslaved-backed securities. As is true of property ownership in any era, those who held slaves had the ability to grow exponentially richer because they could use their property to create more wealth." Her incisive comment neglects the wider benefits of slavery to whites, both North and South. Non-slave owners in the South could earn decent incomes by functioning as managers of the enslaved workforce, by selling products to planters, or by policing for the system. Northern white industrialists in the textile industry were directly dependent upon a key input, slave-grown cotton. The fortunes of New England's most prominent families were frequently linked to the slave trade and to the shipping industry that was allied with it. In contrast, the enslaved were denied the opportunity to acquire assets, to sell their labor for hire, nor were they able to reap the monetary benefits of any technical innovations or other products they designed. Slavery was the foundation of today's huge disparity in net worth between Black and white Americans. 2019 estimates from the Federal Reserve set the average difference in Black and white household net worth at $840,000, a figure sufficiently large that it would take the typical Black household 14 consecutive years of saving 100% of their income to bridge the gap. In fact, if generous donors created a fund to eliminate the racial wealth gap by contributing $1 billion monthly, it would take a millennium to reach $14 trillion. The combined budgets of all state and local governments used to meet all of their obligations amount to less than $5 trillion, but it would require $14 trillion to close the disparity for approximately 40 million Black American descendants of persons enslaved in the United States. Financial institutions were key supporters and beneficiaries of American slavery. The full scope of creditor-debtor relationships interlocked with the slave plantation system has yet to be documented adequately. For the record, details are needed about which organizations financed the New England textile industry, which bank or banks had Brooks Brothers, producers of plantation wear for both the enslaved and the enslavers, as a client, and who were the lenders to the Southern planters themselves. This will require thick archival research that has yet to be undertaken. Several existing major insurance companies participated significantly in providing slave owners with contracts to protect them for financial loss in the event of death or damage of their human property, particularly their highly skilled property. These include New York Life, Aetna, Baltimore Life, Southern Mutual Insurance Company, the Lowe's Corporation, and AIG. J.P. Morgan Chase subsidiaries, Citizens Bank and Canal Bank in Louisiana, became slave owners after their slaveholding clients defaulted on loans. Citibank, Wells Fargo, and Bank of America's predecessors all participated in gain from lending to slaveholders, and also, as a consequence of loan defaults, became slave owners. In the aftermath of the Civil War, the nation made a promise to the formerly enslaved of 40-acre land grants as restitution for the years of bondage. The promise was not kept, and the American freedmen received no land. In contrast, 1.5 million white families were granted 160-acre land grants in the Western Territories as the nation's colonial settler project was completed. Homestead Act patents have benefits that resonate for at least 45 million living white Americans. Eastern creditors supported and benefited from the economic chain reaction of steady growth in the West that built new towns and produced new states, while making the basis for the post-slavery racial wealth gap. During the course of approximately 100 white terrorist assaults on Black communities, from the Civil War to the 1940s, Black lives were taken and Black-owned property was seized or destroyed by the white mobsters. Black property owners who lived through the massacres rarely received any form of compensation. An estimated present value of $611 million of Black-owned property was lost during the 1921 Tulsa Massacre. What can best be described as a Negro clause in the policies gave insurance companies the basis for denying the massacre victims' claims. The insurance companies fell back on an exclusionary clause that said insurers would not be held liable for loss caused directly or indirectly by invasion, insurrection, riot, civil or commotion, or military or usurped power. Christopher Messer, sociologist at Colorado State University, says the clause was inserted in contracts with Black property owners intentionally, given the fact that by the early 1900s, insurance companies were well aware of the high potential for white mob violence directed against prosperous Black communities. Insurance companies would not describe the assaults as massacres, but instead as riots, implying greater neutrality in the conflict or Black responsibility for the destruction.
Dr.
Financial
Darity,
institutions.
Dr. Darity,
Yes. Yes, sir.
I'm going to ask that you suspend, and we'll have to move on, but you'll be given an opportunity to say more when we ask questions. So at this time,
Okay, thank you.
The chair will recognize Ms. Roberts for 5 minutes to give an oral presentation of your testimony. Pull the microphone closer.
Is this working?
Yes.
Thank you. Great.
Thank you.
Thanks. Thank you for the invitation to testify today, Chairman Green, Ranking Member Wagner, distinguished members of the subcommittee, and Committee Chairwoman Waters. Economic systems that developed in the immediate wake of slavery continue to shape how people experience the labor market, the financial system, and their own economic precarity today. For example, in the United States in the 1870s, tipping became an entrenched system of shifting cost burdens from employers to customers, with particular prominence in industries that employed formerly enslaved people, including restaurant, hospitality, and transportation work. Tipping was codified by 1938's Fair Labor Standards Act, which totally exempted those who received tips from any federal minimum wage law. Only in 1966 were employers required to pay any base wage to their employees who received tips. The minimum wage for tipped workers has been stuck at $2.13 an hour since 1991, losing more than half its value to inflation over the past 30 years. While federal law dictates that if a tipped employee makes less than the regular minimum wage, the employer must make up the difference, this system is rife with abuse. More than 17% of low-wage workers reported being paid less than the legal minimum wage, with $15 billion in annual stolen wages. Women represent 2/3 of the tipped workforce. Just under half of workers in tipped industries are people of color, while the total labor force is only 37% workers of color. Employees are subject to the approval of the customer, not their employer, a relationship in which just and fair treatment is less governed by anti-discrimination and anti-harassment law. These workers are subject to harassment and demands on their behavior in exchange for their financial security. One study showed that female tipped workers in states where the sub-minimum wage is $2.13 experience sexual harassment twice as often as workers in states where tipped workers receive tips on top of the regular minimum wage. Lately, 76% of Black tipped workers said they were financially penalized for customers for trying to enforce social distancing and mask mandates, compared to 62% of all tipped workers. Meanwhile, in spring 2020, more than 40% of tipped workers were rejected by their state's unemployment insurance agency for having earned too little to qualify for unemployment insurance. Not only are Black workers earning less than their white counterparts, it costs them more to access and save the money they have earned. This too is grounded in history. The Freedmen's Savings and Trust Company, chartered by Congress in 1865, was intended to provide a savings institution for newly freed enslaved people and their descendants. After several years of deposits, mismanagement and fraud led to the bank's collapse. While most people had already withdrawn their deposits and lost access to interest and dividends during public uncertainty about the bank's fate, The more than 61,000 remaining depositors, many of them recently freed people, lost the equivalent of nearly $81 million. Although the failure predated federal deposit insurance, contemporary advertisements and records indicate that bank representatives led potential depositors to believe that their account would be backed by the federal government and thus immune from risk. Depositors lost significant assets, and many Black families and communities lost faith in financial institutions with good reason. It is unlikely that the Freedmen's Bank disaster is the driver of anyone's personal judgment of the trustworthiness of modern-day financial institutions. But the disaster and its lack of significant consequences for those who contributed to it demonstrate a systemic exclusion of Black Americans from the financial system and of a cultural willingness to accept the destruction of assets and wealth that is accumulated by the Black community. Just before the pandemic, Black Americans represented 37% of the unbanked population, meaning they have no savings or checking account. They represented 23% of the underbanked population, meaning that while they have a bank account, they primarily rely on fringe banking options, such as check cashers. This has consequences not just for wealth building, but for the implementation of the public policy crafted by Congress. When the pandemic hit, people who were unbanked had to wait months for paper checks to arrive in CARES Act-funded economic impact payments, unlike those who got much faster relief through direct deposit. Lack of financial access and lower wages, both of which have roots in the legacy of slavery, compound to make wealth building harder for Black Americans. By removing barriers to mainstream financial services, constraining the ability of predatory actors to strip wealth out of Black communities, eliminating wage disparities, and redressing past wrongs, federal policymakers can make effective changes that could help close the Black-white wealth gap. Thank you for the opportunity to testify today.
The gentlelady yields, and thank you. We will now hear from Dr. Francis. You are recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, Chairwoman Waters, Chairman Green, Ranking Member Wagner, Vice Chairwoman Williams, and members of the committee. My name is Dania Francis. I'm an assistant professor of economics at the University of Massachusetts, Boston. I'm honored to have been asked to address the committee on this important issue. I've been studying the economics of reparations for Black Americans for over 20 years. And during my career, I've also conducted extensive research on racial economic disparities, particularly the enduring effects of racial wealth gaps. In my testimony, I will address the lasting economic harms that slavery had on descendants of the formerly enslaved. From the date of emancipation, Black households were at a significant disadvantage with regards to wealth accumulation. While the relatively small share of Black Americans who were free prior to the Civil War had accumulated some wealth and property, the vast majority of Black Americans were formerly enslaved with virtually no property or wealth at the time of emancipation. A team of economists that included Laura Dorinencourt of Princeton University constructed a continuous series of white to Black wealth ratios in the US from 1860 to 2020, compiled from multiple historic and contemporary sources. Dorinencourt's estimates suggest that in 1860, 5 years prior to emancipation, Black Americans owned 2 cents for every dollar of white wealth. In 1870, 5 years after emancipation, the figure increased to a little over 4 cents for every dollar. However, the gap in wealth at emancipation was so large that simulations suggest that even if Black households had the same capital gains and savings rates as white households from 1870 onward, white households would still have 3 times the wealth as Black households today. Why do these racial wealth disparities matter? Wages and income impact a family's ability to meet day-to-day expenditures and can feed into a family's ability to accumulate wealth through savings and investment of income. Wealth, however, provides additional benefits beyond those provided by stable wages and income. Having wealth can provide a protective safety net, helping families weather economic shocks, such as unexpected unemployment or inability to work due to adverse health events. Having wealth as a protective safety net may also reduce stress and anxiety and improve health outcomes. Wealth also provides access to opportunity. Households with greater wealth are better able to afford homes in neighborhoods with better schools, lower crime, and fewer environmental and health stressors. The risks associated with entrepreneurship can be less costly for higher wealth individuals who have more of a safety net to fall back on should their businesses not succeed. In that sense, wealth provides greater freedom to pursue self-actualization. Thus, wealth provides access to education, provides security to take career risk, and provides seed money for creating small businesses that can eventually grow into big businesses. All of these things are instrumental in building future wealth. In this way, differential access to wealth leads to differential access to education, entrepreneurship, and other wealth building activities. If we ignore the fact that there are racial wealth gaps, we ignore an important root cause of other societal gaps, such as racial achievement gaps, income gaps, health gaps, etc. Barriers to access to wealth and opportunity are not just in our past, they're ongoing. Today, they may take the form of exclusionary zoning policies, for example. If you want to exclude Black families from a neighborhood today, you don't have to engage in blatant discrimination. You can instead pass a local zoning ordinance that requires all residential plots to be at least 1.5 acres or to be single-family dwellings. This has the effect of pricing many Black families out of these neighborhoods because they don't have the wealth endowment necessary to afford properties carrying those restrictions. In a sense, these types of zoning laws then are a way of capitalizing on the results of past racial discrimination in a seemingly race-blind way. In their book, From Here to Equality, William Darity and Kirsten Mullen argue that enduring harms of slavery and ongoing post-emancipation discrimination can be captured in and quantified by current racial wealth gaps. The intergenerational transmission of wealth makes relevant today the historic wealth differentials present at the time of emancipation, providing a direct link from the economic injustices of slavery to the economic disparities of today. The financial and insurance institutions that benefited from those injustices should have to reckon with the economic disparities of today. I thank you for the opportunity to discuss the enduring legacy of harm from slavery and the role of financial institutions.
Thank you, Dr. Francis. The gentlelady yields. We will now hear from Dr. Rockman. You are recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Green, Chairwoman Waters, Ranking Member Wagner, and members of the subcommittee. I'm honored to speak with you today. I join you as a historian whose research has focused on the role of slavery in American capitalism. In my scholarship, I've argued that slavery shaped the terrain of economic development in the United States. I do not believe that our society has fully grasped the degree to which the economic opportunity we celebrate as characteristic of the American experience writ large was historically contingent upon the exploited labor and commodified bodies of Black Americans. My reflections also draw on my experiences as a member of a community that has grappled with its own historical relationship to the ill-gotten gains of slavery. I must acknowledge the hope of Brown University's former president, Dr. Ruth Simmons, that our institution's engagement with our own history might serve as a model for the nation itself in pairing historical truth-telling with accountability and repair. My research specifically considers slavery as a national economic institution, not merely a Southern one, but rather one whose products shaped lives and livelihoods thousands of miles away. In the Pennsylvania and Rhode Island textile mills that voraciously consumed slave-grown cotton. In a small Massachusetts village where virtually every family was involved in making shoes for slaves. In the banks of New York City where numerous financial calculations traced back to the price of cotton and to the assets stored in enslaved people as saleable property. In light of these long-distance entanglements, my position emerges from the difficulty of determining precisely where the economy of slavery ended and some other kind of economy presumably began. These blurred boundaries suggest that the committee must be expansive in how it defines involvement in chattel slavery. For example, how should we reflect upon firms that manufactured slave-grown cotton into textiles and that spurred on the American Industrial Revolution? Remember, for example, that Berkshire Hathaway was once a textile company whose genealogy traces to a New England Quaker entrepreneur and the cotton textile mills he built in Rhode Island and Massachusetts as early as 1806. The proprietors of what was eventually the Valley Falls Company rarely paused to ask where their cotton came from. And as with almost every other firm in the New England textile manufacturing complex before 1865, virtually every cotton fiber they spun and wove would have been slave-grown and slave-picked. New England textile manufacturers, as well as their lenders, their investors, their insurers had a stake in the price of slave-grown cotton rivaling that of any slaveholder. Would not such enterprises then fall under proposed legislation requiring firms to disclose their ties to slavery? The same would hold true for a firm that brokered slave-grown cotton or sugar into global markets like Brown Brothers Harriman, a company which impressively makes this history available on its corporate website. Insofar as the products of stolen slave labor were perhaps more likely to be collateralized than actual slaves themselves, we must recognize that the relationship of finance and slavery was more expansive than we would see if we just scoured the archive looking for debt instruments explicitly backed by enslaved people. Eventually, scholars may find that the wealth created in credit lines, tax breaks, rental revenues, annuities, and sales, that is value created through the market and the law's treatment of enslaved men, women, and children as assets, was comparable to the value of the cotton, sugar, and rice those same men, women, and children produced through their unpaid field labor. As we assign a central role to finance in the overall functioning of American slavery, we must remember that references to property that was liquidated or settled or secured referred to husbands being sold away from wives, parents from children, transactions with affective costs far higher than anything that could ever be listed upon a balance sheet. To conclude, I want to concur with an earlier comment from Professor Darity in his April testimony that the largest burden falls upon the federal government, under which all of these horrific transactions and speculations were legal. Entrenched legal definitions of property and people and prevailing legal commitments to the sanctity of contract allowed the edifice of American finance to be built upon enslaved labor, reaching deep into places where slavery itself had already been abolished. Slavery was a national institution, and whatever successes we will have in redressing slavery's long-lasting harms must be national in scale. I commend this committee's effort to put Congress, the deliberative body that legislates on behalf of the nation, at the forefront of specific policymaking that will seek to close the racial wealth gap, create civic space for remembrance and reconciliation, and preserve a truthful accounting of the American past, lest anyone in the future try to erase the fundamental fact that for much of our nation's history, market freedom and human freedom stood in painful opposition to one another. Thank you.
Thank you, Dr. Rockman. Dr. Felderman, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, Chairman Green, Chairwoman Waters, and the distinguished members of the subcommittee. Thank you for the opportunity to speak today. My name is Sarah Fetterman. I am a professor at the Kroc School of Peace Studies at the University of San Diego. My research looks at the intersection of corporations and mass atrocity, how they atone or reckon or do not for genocide, slavery, and colonial legacies. And I began my career as an international advertising executive. But I discovered that when you trace the thread of cotton through U.S. history, it does lead us to Wall Street and the finance industry more generally. Today, I've been asked to share a little bit more about the challenges of corporate reckoning, why we must proceed, and how best to do so. One of the arguments that we run into when engaging with corporations is that it's applying the law ex post facto because slavery was legal at the time. Well, I'm not a legal scholar. I want to remind us that we are not pursuing criminal justice in these efforts. We are pursuing transitional justice through which nations and institutions differentiate themselves from a prior criminal regime by addressing the harm and committing to ethical behavior going forward. Most financial institutions that profited from slavery have not yet done this work. We also hear, rightly so, that we're all beneficiaries of cotton capitalism and plantation agriculture. So why focus on the banks? So here I underscore another prior point that, yes, this will require government and taxpayer participation, but corporate as well. Another argument is that many businesses profited from slavery, both in the North and in the South. Look at Lehman Brothers. Companies have folded. Most have folded. So is it fair today to only hold the surviving enterprises accountable? To this I say, when legacy companies continue to profit from their heritage brand and strength due to ill-gotten gains, but do not participate in the reckoning work, they continue their complicity with the prior regime. All institutions with these ties want to commit to transparency, relevant institutional reform, and to work with the affected communities. We also hear that everyone directly impacted by slavery is dead. Those here today and many others have detailed the legacies of slavery in the present. My written testimony, offers some of these sources. Another argument we hear is why punish today's executives, employees, and shareholders for the ill deeds of the past. First, I would like us not to use the word punish because this is about addressing the harm, not focusing on punishment, so a more restorative frame. But beyond that, leaders of all institutions inherit the problems of their predecessors. Corporations and their leaderships can't refuse to address failed product lines or underperforming divisions simply because they did not create these problems. It is for leaders to take responsibility of those challenges in front of them, not just for their actions. Let's say corporations contribute to a fund like the German corporations did. How best to distribute the money? I do want to say that descendants and policymakers will never reach a consensus. When I interviewed Baltimore students and families, some wanted a check, others worried the money would disappear, some didn't want money from white people at all, and others were concerned that compensation would be a way to shut Black Americans up without sharing power or actually challenging discrimination. So how best to proceed? Many people know what to do. We know what to do. There's many effective underfunded programs like Safe Streets and Restorative Justice for Oakland Youth. There are experts doing great work in this area, like the California Reparations Task Force that has identified 5 major areas: housing discrimination, mass incarceration, unjust property seizures, devaluation of Black businesses, and healthcare. To this, I would add education. I saw in Baltimore how student loans became modern day shackles. I believe offering 3 generations of free higher education to Black Americans will help undo some of this harm. Whatever we decide to do, the details matter. Holocaust survivors told me, many of them told me, that the letter they received from Germany was as meaningful as any money, that to have that recognition. Given that compensation can actually even worsen discrimination because other groups don't understand why they haven't been compensated for their losses and their suffering. To mitigate this backlash, we must continuously educate those who do not know the history or understand the legacies of slavery as we move forward. This is a very divisive issue. You can never undo all the harm, and we can never undo all discrimination. So why bother? Well, we address the harm of Black American families, not because it is easy or for accolades. We do it because these families have been repeatedly deprived of life, liberty, property, prosperity, and dignity. And if the United States wishes to continue to have any legitimacy on the global stage as advocates for human rights. Thank you to those who have educated me and those new to this work. As thankless as it may feel at times, you'll help people you never hear from and acknowledge those who suffered their entire lives without recognition. Thank you for your time.
Thank you, Dr. Fetterman. Witnesses are all reminded, if I may say so, to keep your cameras on. To remain a part of the hearing, we must have you on camera. So if you would kindly comply, we would be eternally grateful. I now recognize the chairwoman of the full committee, the Honorable Maxine Waters, for 5 minutes for her questions.
Thank you very much, Congressman Green. I first would like to thank you for having not only the courage, but the energy that you're putting into raising, I think, one of the most significant questions about slavery that could possibly be raised, and you're in the right committee, to do that in the House of Representatives. I want to address a question to Dr. Darity. Do you believe that local laws and ordinances such as the City of Chicago's Business, Corporate, and Slavery Error Disclosure Ordinance passed in 2002 are effective measures to ensure financial institutions remedy any harm they cause through their involvement with slavery? In your opinion, should the federal government model these laws and require similar audits? Before you're answering that, I just want to, number one, remember my good friend, Dr. Ogletree, who has been involved in an aspect of this issue for so many years. He took me to Tulsa, and I've been to Tulsa several times, and I got to meet some of the survivors of the massacre that was right here and the Supreme Court case that took place. And so I have watched what was being done in Oklahoma. And when we talk about these local ordinances, I don't see that in Oklahoma they've been able to do more than kind of apologies, and I don't even think they have a statute. They have something else that they were doing. So, Dr. Darity, the question becomes, what about these local laws and ordinances? Are they effective?
I think the local laws and ordinances that seek full disclosure for the historical record from companies that do business with cities and states have been effective. The Chicago case has generated a significant amount of information about the historical practices of a number of firms. And so I think that's something that could be effectively replicated at the federal level. And I think it's very much in the spirit of your June 2020 inquiry with a number of corporations. There needs to be some teeth behind that inquiry in the sense that if they don't follow through, there should be some penalty that they're subjected to. But I think that is a very wise set of ordinances. In terms of other types of policies that have been pursued at the state and local level that aim at restorative justice, I'm probably not quite as enthusiastic. I don't think that the issue of the racial wealth gap in the United States can be addressed in any significant way without the federal government adopting a program of reparations for Black American descendants of U.S. slavery.
Why do you believe that the Tulsa massacre has never been significantly addressed in Oklahoma? They have not done anything with local ordinance, have they? Dr. Darity? Anybody? He's off the screen. Does anyone know what has been attempted in Tulsa to deal with the massacre that basically killed, murdered, and burned down all of the businesses of the Black community in Tulsa? Anyone
I
have any-
apologize. I lost audio a moment ago, so I couldn't hear what your question was.
Well, my basic question is, have you any knowledge about anything that's been done locally in Tulsa to deal with
Yes.
this issue significantly?
Yes, you mentioned Dr. Ogletree, and he was deeply involved in an effort to try to get some sort of judicial-based compensation for the victims of the Tulsa massacre. And I think that most of the efforts that have been conducted in the Tulsa context have been attempts to go through the courts for some form of compensation, given the fact that the insurance companies did not provide any compensation.
Well, I want you to know that some of the original Black business individuals were alive when Ogletree was working on this issue. I met 3 or 4 of them. They're all dead now, but they got no
Yes.
compensation.
They got no compensation. But I don't think this can be handled by going through the judicial route for one fundamental reason, which is that the federal government ultimately has jurisdiction over this array of massacres. There was 100 of them that took place. And the federal government either turned a blind eye, or it actually provided, in some instances, the arms that were used by the white terrorists. And so I think we really, again, have to turn to the federal government to try to address the full array of atrocities that
Thank
took
you
the
so
form.
much, Dr. Doherty. I'm way past my time. The chair has been very generous. Thank you very much, Mr. Green.
The gentlelady yields back. The chair now recognizes the Honorable Ann Wagner, the gentlelady from Missouri, for 5 minutes.
I thank my friend Chairman Green for the time, and again, thank our witnesses for being here today. As I mentioned in my opening, that right now, the cost of goods is rising at a faster pace than the rate of wage growth, and people are being forced to put a larger portion of their paychecks towards necessities to make ends meet. Studies show that inflation is disproportionately more difficult to bear for lower income and minority households. And just last week, during our full committee hearing on the ties between housing and inflation, we saw that many households throughout the country are limited by rent or home buying power or lack thereof. Dr. Darity, do you believe that the current inflation rate is exacerbating the racial wealth gap?
I certainly think that the current inflation rate, as you suggested, has a disproportionate impact on low-income families and particularly Black and Latino families as well. But I don't think there's a significant relationship to the racial wealth gap. The racial wealth gap is primarily driven by the intergenerational transfers of resources that are disproportionately held by white Americans in comparison with, say, Black Americans. Dr. Francis talked about that in some detail in her remarks. I think that the inflation has an adverse effect on people's capacity to save, but personal savings is not the primary factor that drives people's wealth accumulation. It's what you get from your parents and your grandparents that is really decisive in terms of determining your wealth position, and that has been racially disparate in the United States for multiple generations.
Well, let me go on and kind of cite the Bureau of Labor Statistics here. And according to them, the median weekly earnings in the third quarter of 2022 for Black, Hispanic, Latino workers with full-time jobs were about $300 lower than those of white and Asian workers. Dr. Darity, if wages rise slower than the rate of inflation, what is the net effect? And is it therefore fair to say that rising prices are disproportionately more painful for Black, Hispanic, Latino workers?
No, I acknowledge that, but in terms of the implications for the racial wealth gap, they're marginal. They are not significant or important. The racial wealth gap is not primarily a consequence of differences in savings outcomes across families. It is a consequence of the inability of Black families to transfer substantial resources to subsequent generations because of the nation's history of deprivation of previous generations from the opportunity to accumulate wealth.
Thank you, Dr. Darity. Dr. Fetterman, you talked a little bit about the research that you have done. Can you elaborate a little bit more about what the difficulties are in finding kind of a one-size-fits-all solution with such a large group of impacted people? What steps do we need to take to understand all of the perspectives?
Thank you for that question. And I think one is to prepare ourselves that there's not going to be consensus, and that doesn't mean that there's something wrong. As we move forward in working with affected communities, for example, and Dr. Rockman talked about Brown Brothers Harriman, but that's from the Alexander Brown and Son family, which is based originally out of Baltimore. There's so much to do in Baltimore that the banks could work together in that area, those institutions that are legacy institutions, to just address what's happening in Baltimore. So there's a lot of local level activities that can be done. People in these communities know what they need. We can walk into these communities and know what they need. So it's not terribly mysterious, but I think, we're going to want to look at a plan that includes the housing. And in the wake of George Floyd, when we saw a lot of American financial institutions give money for racial equity, they often did it in the form of loans that they could profit from. And I think it's very important as we engage these corporations going forward that we're talking about grants, housing grants, student loan grants as well, not just more loans because people are so buried into debt. So I think we want to engage continuously with affected communities, have these conversations with them about what they need, support those organizations that have proved to be effective, that are simply underfunded. And then there may be a conversation about whether people should be getting checks. I mean, that's going to be a conversation for the nation to have as well.
Thank you very much. I have used all my time, and I yield back to the chair.
The gentlelady yields back. The gentlewoman, the honorable woman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you so much, Chairman Green, for holding this hearing. It has been truly an honor to serve under your leadership on this subcommittee, from hosting you in the 13th District to this incredibly important historic work that you have tackled on and looking at the unthinkable horrors of slavery with the urgency that justice demands. So thank you so much, Chairman Green. I also want to thank our witnesses for their exhaustive research Due to your work, we know the historical role of slavery in the financial industry is not abstract. The legacy of American slavery is still being felt in our communities across our nation today. We cannot look away. We must address these horrors. So that's why I really appreciate this subcommittee hearing. We look at financial institutions that responded to our subcommittee's inquiries. Of the 7 institutions that found historical connection to slavery, just two have taken any steps. Of these 2 institutions, Truist provided a public acknowledgement, and then JP Morgan created a $5 million scholarship fund. Those are the 2. To all of our panelists going down the line, yes or no, do you think these remediation steps are sufficient to acknowledge and atone for the role in American slavery? Dr. Darity?
Your volume, your microphone, Dr. Darity, please.
Sorry. No, I don't think that these are sufficient. And I have argued in the past that what financial institutions ought to do that would be a substantial act of atonement is to build the endowments of historically Black colleges and universities to a level comparable to their predominantly white peer institutions. I think that would be a step that would really be substantive.
You answered my second question, Dr. Darity, so I appreciate that. I do want to ask, Dr. Francis, do you think that these remediation steps by Truist and JP Morgan are sufficient to acknowledge an atonement for their role in American slavery?
No, I don't think they're sufficient.
Ms. Roberts?
No, and it also seems that the lack of response from other institutions is insufficient.
Absolutely. Dr. Rockman?
Insufficient.
Ms. Fetterman?
Insufficient.
And so my next question, and I know Dr. Darity discussed it, but what recommendations of what they can do to properly address their role in American history? Dr. Francis, I know you talked about a little bit about this, but what do you think that we can do as a subcommittee to push them towards the appropriate response?
Thank you. Thank you for the question. I think that financial institutions should commission studies to fully examine their historic involvement in and benefit from slavery. There should be greater transparency in the financial services industry regarding racial disparities and their current lending practices. Financial institutions should commit to funding and resources to community development activities in Black communities, and these efforts should be guided by local Black organizations. They should also review ways their current policies and practices may internalize and systemize racial discrimination in the form of race-neutral, wealth-related requirements. And I also will note that Dr. Fetterman had a lot of excellent recommendations in part 1 of this hearing regarding steps for atonement. But importantly, I think that these atonement activities should not be mistaken as reparations, which, as Dr. Darity mentioned earlier, involve a much larger federal effort.
No, thank you. Just so has some time. So, a critical part of the process is properly understanding the role and the value of slave labor and how it affected the overall labor market in the U.S. economy. So, Dr. Rockman, can you help us understand the effects of slave labor within the U.S. economy on the broader labor market? Could the unpaid labor of enslaved people have comparable value to paid labor at the time? Or did the very existence of unpaid labor fundamentally skew the entire labor market?
I would argue that the presence of enslaved labor in the U.S. South actually skewed the entire labor market of the United States as a whole, including setting some of the wage levels thousands of miles away in the North, but also in perhaps say, mitigating some of the class conflict that might have grown necessarily out of the development of the wage system. If we look at the transition to factory capitalism in Europe, we see massive conflict between workers and their employers through much of the 19th century. We see significantly less of that in the United States. What if it turns out, hypothetically speaking, that it's white supremacy and a commitment to keeping Black people enslaved that created solidarities between white workers and white employers in the North that mitigated some of the bumpy political transitions that accompanied capitalism in the 19th century? That would change everything.
Yep, with that, I yield, Mr.
The
Chair. Thank you so
gentlelady's,
much.
thank you. The gentlelady's time has expired. The chair now recognizes the honorable gentleman from Illinois, Mr. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and thank all the witnesses for joining us. I want to thank everyone that has kept this issue and this great challenge to our country alive and probing for answers and information. In 2002, as the chairwoman of the committee has pointed out, Chicago became the first major city to require companies interested in doing business with Chicago to disclose their ties to slave trade and labor. As a result of this ordinance and additional legislation from states that followed, financial institutions have disclosed the profits they got from the financing of slavery, prompting apologies and renewed commitments to diversity and inclusion initiatives. But disclosures and apologies from financial institutions are not enough. We need legislation that requires actionable steps from public companies to address their ties to slavery and to keep history of racial inequity and economic disparity in the U.S. To witness Dr. Francis, Evanston, Illinois, has created a plan to provide housing grants to Black residents, prioritizing descendants of those who were harmed by discriminatory housing policies in the city. Do you believe that these initiatives sufficiently compensate for the suffering of Black Americans, and should they be implemented more broadly?
Thank you for your question. I don't first. No, I don't think they're sufficient. But I do recognize the spirit in which they are arrived at, and I think that the reckoning of local jurisdictions have been doing with their past and their connections to slavery and discrimination are honorable and should be encouraged. But again, the sheer size of what would be necessary, right, to atone for, to repair, to address the history of slavery. Again, thinking about the size of the racial wealth gap as symbolic of that is much too large for any local jurisdictions to be able to marshal on their own. So I guess maybe to conclude, I think that it's good grassroots energy to think about mobilizing people at the local level, but it would be much better if that grassroots energy was devoted to a concerted national federal response.
Thank you. This question will be for both Dr. Darity and Dr. Francis. So be mindful of time. We've got about 2 minutes. The U.S. economy has benefited from centuries of unpaid labor and the business generated from slavery. You have estimated that a program to remediate this harm could cost the U.S. government between $10 trillion and $12 trillion. How should the federal government structure the reparations program, and what can financial institutions do to address current structural disparities that could be traced to slavery? Dr. Darity, we can't hear you. I think you're trying to speak.
Dr. Francis, you want to start with this one? Or?
1 minute and 20 seconds, just.
Okay.
Sorry.
Absolutely. So there are many ways that we can address a reparations program, financing reparations through taxing and transferring. Reparations programs can be implemented as cash reparations, as trusts, and this is something that I think people have spent a good amount of time researching, and but we still have unanswered questions. And I think that's why it's important to establish a commission to work on this and develop further solutions.
Thank you, Dr.
The bill to
Darity.
eliminate the racial wealth gap is at least $14 trillion. the federal government has demonstrated its capacity to make those types of levels of payments, particularly if it's distributed over a 10-year time span, in terms of its response to the Great Recession and also its more recent response to the pandemic.
Thank you to both of you, to all of our witnesses. Mr. Chair, I yield back.
Gentleman yields. The chair now recognizes the honorable gentlewoman from Texas, Ms. Garcia, who is vice chair of the Subcommittee on Diversity and Inclusion.
Thank you, Mr. Chairman, and thank you to all the witnesses who are appearing before us today. It is great to see that we are continuing this discussion in this second series of discussions on the enduring legacy of slavery. I am reminded over and over that racism and the lasting horrors of slavery are built into every fiber of our financial system. The topic of today's hearing and the subcommittee's research into the history of financial institutions profiting from slavery reminds me of this even further. Our nation's history in this regard is dark. We must work tirelessly to right the wrongs of the past because they are not the past. The lasting impacts of slavery continue to impact Americans every single day of our lives, and particularly in the financial sector. Throughout my time in Congress, I've committed myself to equity in financial services, striving for financial health and success for all Americans. During part one of this hearing series, I asked about tangible steps that we could take to make the finance system more equitable. In reviewing today's committee materials, I understood that they need to continue with that line of questioning because concrete, actionable progress is still urgently needed. I think some of you mentioned some of this being insufficient, and I agree with you. Dr. Darity, of the financial institutions surveyed by this subcommittee, a concerning low number of companies with ties to slavery have taken real concrete steps to enhance their community investments, or as a great example that you used was, dollars to the endowment funds of the historically black colleges. In an era of public commitments to diversity and inclusion from industry giants, but perhaps too little action, what concrete actionable steps can financial institutions do, like immediately, without us in Congress dictating what they should or shouldn't do?
I think immediately they could take steps to raise the endowment levels of historically black colleges and universities to a position that would be comparable to peer historically or predominantly white institutions.
Right.
That's a step that they could take immediately.
Right. Is there any other example that you can give us?
Of other types of steps that they could take?
Yes, sir.
Well, they certainly could make sure that they're in some sense that they could get their own houses in order, in the sense of ensuring that their own personnel, staff, and leadership is reflective of the composition of the national community at large. And that's a diversity and inclusion project.
Correct, and we do have a subcommittee on that. We work on that real hard. Ms. Roberts, we have data that shows that Black and other minority populations have extremely reduced access to lending services and other forms of capital necessary to help businesses thrive. In practice, how do we address this? What can Congress do, and what can banks do to ensure access to capital is more equitable?
Thanks for the question. Ensuring that all communities have access to capital could require something as easy as investigating their own sort of openness and accessibility to different communities, ensuring that information is available in community in which, based geographically and based on neighborhood, in the language that is spoken by the community that's relevant, and ensuring that services are accessible with little or to no financial barrier in order to get in the door. That's good for banks' business. It would ensure that they have sort of a robust customer base that they're building up. But I also want to point out that shareholders have power in this capacity as well. In different financial institutions, shareholders are making demands all the time of business practice and ensuring that institutions are behaving responsibly in terms of the environment, in terms of investments, they could also be doing so to ensure that financial services are accessible to a wide range of communities.
Thank you. Ms. Roberts, I wanted to quickly talk about today's current redlining. It's no longer people getting together and actually drawing red lines on a map. It's done with algorithms and online applications that will know who to invite in and who not to. What can we do to have better access to home ownership despite some of these barriers that seem to be cropping up and we just can't seem to, it's what I call the high-tech redlining.
Ensuring that financial institutions are not using algorithms in a discriminatory way is a really crucial part of this, but there's also still a human element. Significant research has shown the lower valuation that happens when a home valuator or assumes or knows that the owner of the home is Black. That's shown significant impact on neighborhood-based home price increases over the past decades. So federal government efforts to ensure that there is a check on valuation discrimination is a really crucial part here, as well as providing upfront capital and support. That's happened at the local levels. For example, the District of Columbia has been working on that significantly to increase the support for first-time homebuyers and others who have been excluded from the intergenerational transfer of wealth that Professor Darity so clearly has articulated here.
Thank you. I think my time is up, Mr. Chairman. I yield back.
The gentlelady's time has expired. The Honorable Gentlewoman from Georgia, Ms. Williams, who is Vice Chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Mr. Chairman. In the post-Civil War era, the exception clause of the 13th Amendment was exploited as Black Americans were arrested for minor crimes under Black codes and then were leased out to work in many of the same places they had previously been enslaved. Dr. Rockman, can you give us a sense of the economic impact of the exploitation from the exception clause?
I'm afraid that that's beyond the purview of my own direct research, but my sense is from what seems to be a scholarly consensus around the issue is that the economic exploitation of Black Americans existed before slavery and after slavery, in the 18th century, in the 19th century, and in the 20th century, and wherever we chose to start the clock in looking for where we need to address repair, we will find ample cause to do so.
Thank you so much. And Ms. Roberts, today, what role could the financial industry play to pass a bill like the Abolition Amendment to fully eliminate the exception clause as industries work to ensure equity and atone for the past?
Financial institutions obviously have enormous capital, and with capital comes political reach. And I would encourage financial institutions to think critically about the ways that they are using their political reach to advocate for policies that will bring more people into their doors as future customers. With financial stability comes greater access to financial services. It would be to the advantage of many of these financial institutions to ensure that all Americans have an economic level playing field.
Thank you, Ms. Roberts. I think the Abolition Amendment, that is a great bipartisan piece of legislation, is a great start. And with that, Mr. Chairman, I would like to yield the balance of my time for you for any questions that you might have.
I thank the gentlelady for yielding and would move forward with a question before I yield time to myself as I'm next in line to speak. Friends, at the September 21st hearing, I presented the CEOs of the largest U.S. banks with information on their connections to slavery. I asked if they'd done enough to atone for their connectivity to slavery, to which all indicated they had. However, thereafter, I followed up and asked them if they had and would commit to preparing an atonement plan. And I asked if they would raise their hands if they were prepared to submit an atonement plan. These are the persons present, and none, not one, raised a hand. I mention this because, you may move it away. I mention this because I think the point that has been made today by several members, including Mr. Garcia, Ms. Beatty, who is not here, Ms. Garcia, who's here, Mr. Garcia, Ms. Garcia, and members of the panel, including Dr. Darity, the notion that we will be able to resolve this by simply having these very wealthy businesses simply cooperate, which is what I would like to see, doesn't seem to be manifesting itself. I just don't see that happening in the current circumstance that we're dealing with. So given that it doesn't, I have a bill that I filed as a placeholder, and this bill would simply give us the opportunity to amend it and later on file an additional bill that would allow us to move forward with the kind of bill that you've been discussing and calling to my attention. It would be H.R. 9337 that's been filed, and it requires the Securities and Exchange Act to allow us to have racial audits, racial equity audits. I think that this is a genesis, but I think there's much more that we need to do. So what I'd like to do is ask Dr. Darity about your desire and belief that we can have these endowments funded by these institutions. I've had the honor of working with you, Dr. Darity, and I believe you've presented a plan, a sort of outline as to how this can be accomplished. So would you take just a moment, please, and explain how you would have this take place as it relates to the financial institutions?
I think I'd like to talk about a specific example, which is the case of JP Morgan Chase that had two subsidiaries that were based in the state of Louisiana. And I performed an exercise of examining the historically Black colleges and universities in the state of Louisiana and matched them with peer institutions. So, for example, I matched Dillard University with Tulane University. I matched Southern University with Louisiana State University and looked at the per-student differentials in endowments
Dr. Doherty,
across
I'm going
those
to
institutions.
ask that you suspend for just a moment because the time for Ms. Williams has expired. I now recognize myself for 5 minutes and would ask that you continue. Thank you.
Okay, thank you. I came up with a calculation of the amount that would be required to bring the endowments of the historically Black colleges and universities in Louisiana on par with their peer historically white institutions. And if I recall correctly, the total amount was not particularly staggering relative to JP Morgan Chase's assets, which are now, I believe, in excess of $3 trillion. It's interesting that it was mentioned earlier that they had set aside a fund for $5 million. I think that that's a very, very small allotment given the scale of their resources.
Thank you. Let me move to another area of great concern for me, and the chairwoman mentioned this in her questioning, and that is, why have we not moved along to a greater extent in trying to get this reparations and atonement, I separate the two, get this done? I find that many people are ashamed of being associated with the title slave. I consider myself a proud ancestor, proud to be associated with my ancestors who are slaves. I think that that's a part of my heritage. They built the country to a certain extent. They are the foundational mothers and fathers of this country. The Capitol building, at Yale, at Harvard University, they've constructed facilities there. And I'm very proud to be a descendant of the people who built the country, but many are not. So I'm asking now, how is it that you think we can get beyond this being the perfect victims, the persons who are victims yet ashamed to acknowledge that we are associated with an institution that we did not create, but that has caused us great harm over the centuries, not over the years, but over the centuries. Who would like to give me some assistance? Yes, if you'll announce your name and speak, please.
Thank you. It's Dania Francis. I think an important aspect is education, right? We are afraid of teaching the history of this country in a way that erases all of these things that we don't want to see, right? At the university,
Let me interrupt for just a moment because you've gone exactly where I'd like for you to go. Now, in Texas, we're making it almost impossible to teach this type of history because it's being labeled as something that is antithetical to the best interests of children. Are you familiar with what I speak of? Okay, you may continue, please. How do we
Yes, sir.
address it?
Absolutely. And so I think it's a local problem that becomes national, and we need to have solutions that address it locally as well, right? So we need to be in those school board meetings. We need to mobilize and try to take back, right, some of the control over the curriculum in spaces that are trying to deny what is the documented history of the country. And so I think it's a local problem that we have to address. There has to be a grassroots effort in order to avoid the larger national problem that it's becoming.
Thank you. Finally, I'd like to ask each of you, if you would, to give me a yes or no answer to this question. This committee has jurisdiction over financial institutions. Do you believe that we should develop legislation that would have an impact on financial institutions should they fail to engage in atonement? And I'll leave its at impact as opposed to the type of impact. We'll just say impact for now. So let's start with Dr. Darity Jr. Your thoughts, yes or no, should we?
Yes.
Dr. Francis?
Yes.
Dr. Roberts?
Yes.
Ms. Seth Rockman?
Yes.
Mr. And finally, Ms. Sarah Fetterman.
Yes.
All persons having agreed, I think that you've given us reason to move forward with legislation, and I will encourage my friends who have addressed this issue today to help me with the legislation. Both Mr. and Ms. Garcia, Ms. Beatty has already been involved with this, and let's see if we can come up with legislation that will, Ms. Williams as well, that will help us to encourage our financial institutions to atone for their connections to slavery that have benefited them over the years. I thank all of you for appearing today, and at this time, I would like to remind, let's see, hold for a moment. Okay, I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the record, and these questions should be submitted to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to email address that is provided to your offices. This hearing is now adjourned, and I thank all of the witnesses again for being with us and look forward to having a follow-up visit with you.